Welcome to Wealth Beyond the White Coat, a show where we dive deep into the world of financial freedom for dentists and medical professionals. I'm your host, Deren Flesher, a dentist with a passion for uncovering the strategies that lead to a prosperous life beyond the office. Every episode will explore the avenues of alternative investing, tax mitigation, and secrets to build wealth that the textbooks don't teach you. Whether you're looking to enhance your financial literacy, discover new investment opportunities, or simply find a better way to manage your money, this is the place where your financial health is the core of our conversations. Welcome to Wealth Beyond the White Coat, where your journey to financial clarity and freedom begins. All right, welcome back. In our last episode, we continued our insightful discussion with Rob Woomer from Skyway Capital Markets. We explored the nuances of investment strategies, the importance of risk management, and the complexities of value-add opportunities in real estate. Today, in the final part of our series, we will dive into the current trends across various asset classes, discover why certain sectors are gaining momentum, and learn how to identify the best opportunities in today's market. So be sure to stay tuned as we wrap up this great conversation and uncover more strategies to help you build wealth beyond the office.
Yep. So I think that if you think about the risk profile and you think about getting into an asset, whether it's something that's bought after you've made the investment or they bought it and they're going to mark it up or transfer it to the fund or whatever they do, there is a case to be made to buy an existing asset from everything we're buying from somebody, then we hope there's meat on the bone. So your biggest risk is when you have a new asset. So a development deal where there's just a piece of dirt. You've done a lot of study around the market. You have a reasonable expectation that there's a need for that. We see the most activity in that asset class around apartments because there's a shortage of housing broadly. Single family homes, apartments, condos, there's a shortage expected over the next 5 to 7 years, mostly in the South and Southeast. But so you do your studies and you look at what's going to rent for and everything. You're taking a lot of risk because you're investing in a piece of dirt and it takes a couple of years to build it. And then you've got to stabilize it, lease it up. And then you hope it performs what it's supposed to perform. Now, in this market, with inflation being where it's been, with the demographics putting wind in our sails, it's very hard to really screw up a deal like that. But it is riskier because things can go wrong when you're doing a development deal. But that development deal then eventually becomes a stabilized apartment, meaning it's leased up in something in 90 to 95% lease up rate. Its rents are at the market. You can't really push them very heavy. You can just go wherever inflation is going or whatever's happening in the market. And it turns into not a risky, I'm going to go from dirt to a product and try to double my money, to now it's a stable source of predictable income and I'm going to make 7 to 10% or some number over a period of time. But what a lot of investors do when they get to that point, so some different owners have different views on things. There's a lot of short-term thinkers that say, okay, I'm going to buy that asset from the developer at some price. Now it's going to be a stabilized cash flow generating machine. And let's just say it's generating a 10% cash flow. I'm going to do everything I can to get that 10% to 11% because that's important to me. And what they do oftentimes is they don't put money into it. They let it spiral down. And what happens is if you're not maintaining it, you're not putting the proper capital in to maintain the quality, then either you can't keep up with the rents because people don't want to pay as much. They don't want to pay more for a product that's getting worse and worse. Or in the worst case scenario, you've let it go to heck and you've got bad management, you're not putting capital in, and then rents can actually decrease. And so what happens then now becomes potentially a value add opportunity. So now somebody else can come in and buy it and fix it and bring it back to that standard, whatever that was originally envisioned when it was built, was originally executed, get new ownership in there, have better management, capital into it, change out the carpet, maybe do a new kitchen, a new bath, something that makes it very attractive and push rents and put it into the higher return. But then it gets to a point where it's stabilized, it's at the market, it's performing very well, and another buyer can come in and now they're buying steady, predictable cash flows. And they could be a buyer that just can hold this for 20 years and have those steady, predictable cash flows. Or they could be another one of those buyers that are short-term thinkers that are just going to let it deteriorate. And then you get another opportunity to buy it, value add back. So there's one company I've worked with that bought an asset 3 times over the course of 20 years. Same asset, same situation every time, had it running great, sold it to somebody. It went downhill. They bought it, fixed it, running great, sold to somebody, and then bought it again. Crazy story, but they were able to make money in the same asset. Now, value add, typically you expect returns 12 to 15, 16% annualized returns. They did that multiple times on the same asset. So there's a case to be made for taking assets and marking them up, or not marking them up, but taking existing assets and putting it in. But if you've got the same management team and they're telling you it's a value add opportunity, you've got to ask a lot of questions, because why is it a value add opportunity? You've been running it all this time. Why didn't you fix it before?
Rob, you bring up a couple of good points. Hold on a second, Ross. I want to back on the back of that. It's too fresh. So he talked about a 12 to 15% rate of return on an asset. I want to be clear, in an asset like that, return stream would be bifurcated. There would be two parts. There would be cash flow that would be on a current pay, and then there'd be the appreciation of the asset when you ultimately exited your strategy. So over time, you might realize between a 12 to 15, but it might be 4 to 6 current cash flow, and the rest of it comes in appreciation later on your unit. The other thing I wanted to piggyback on there is, in the past few years, look, the value add trade in multifamily has been a hard trade depending upon the lens that you look at it through over the past few years, right? There's been a lot of people that have bought value add assets that I would argue there was nothing to value add. Like, the builder developer had a great asset, was maximizing value of it. Some group raised some capital, came along and said, oh, we're going to build a dog park and push rents $100 a door, but yet it never operated units before. And the developer's like, sure, I'm leaving meat on the bone for you, pal. That developer was not leaving meat on the bone when he sold that building. He was not doing it.
You know what it could be?
You got a lot of amateurs doing the value add now.
But see, here's the thing. So you guys remember, we had this thing called COVID, and then you saw rents going, inflation with all the money printing, everything. Rent's going 10% a year, right? So you had people coming in and saying, oh, this is a value add. I keep pushing these rents and I'm going to do this to do it. But here's the problem. There may have been, and I'd argue in many cases, if not most or all, there's value add opportunities by looking at an asset a little bit differently and trying to get incremental returns. But where people get in a hot market, we had 21, 22, 23 were hot markets. 23 less, but 21, 22 for sure. And in a hot market, people come in, whether they're experienced or not, and they get caught up in the hotness of the market, and they pay the seller for the work they're going to do, right? There's value add. I'm going to come in, I'm going to remodel things. I'm going to come in, I'm going to push rents. And geez, because I'm going to make all this value, the seller is going to try to extract as much out of it as possible. So I start taking from the future returns and giving it to the seller. So in many cases, they didn't necessarily overpay for the asset, but they paid so much that they're not able to get that value add, because they basically took the profits and the value they were going to create and gave it to the seller. And I've seen that in my 25-year career. I saw that in 2006 and 7 when the market was insane. I saw that the last few years. I saw that in 16 and 17. There's just been points in the cycle where people irrationally are willing to overpay because they're either too optimistic or they're just inexperienced in dealing with value add transactions.
Hey, I just want to interrupt real quick and say thanks for listening to the podcast. If you didn't know, we have an associated Facebook group also called Wealth Beyond the White Coat. Over there, you can ask your questions, get feedback from group members, and have a close community of medical professionals who are likely interested in the same things as you. Whether it's alternative investing, tax mitigation, ways to keep more of your money, or even protect your assets, we're going to discuss those things in the group. Additionally, we have a private investors club called Legacy Point. As a member, you'll get exclusive discounts to preferred vendors, and you'll get access to private investments that you'll find nowhere else. Whether it's hotels, apartments, oil and gas, equipment rental, you name it, we'll be discussing those details and offering those investments to members only inside Legacy Point Group. If you want to learn more about that, please contact me, or simply email info, I-N-F-O, at legacypointgroup.com, or go to the website legacypointgroup.com. And Wealth Beyond the White Coat podcast listeners get an exclusive discount if you use the code WealthBeyond. That's all caps, all together, WealthBeyond at checkout. I'd love to have you in the group, and I'd love to see you making more passive income as you move towards financial freedom, whether it's freedom to retire early, spend more time with your family, go on more vacations, or just do more of what you love while you're in the operatory. I'd love to see you doing that as part of Legacy Point. So here's to improving your financial health.
Yeah,
So-
so you're saying experience in actual value add over a 2-decade period matters more than the education you might possess in another industry or something, right? A lot of smart people make mistakes when they get out of. I joke all the time. I see a lot of rich guys make money doing other things and then decide to buy bars and restaurants, and because they've eaten at bars and restaurants their whole life and they think they're going to be good at it and they're terrible at it, right? And they're like, that was the worst proposition I've ever been a part of.
So,
Yep.
so Rob, as we record this, it's basically summer 2024. You said that you're bullish on energy and you have the experience to see, because of the deal flow, you see a lot of different asset classes, a lot of different strategies. And we joked earlier that obviously office in California would not be something we would be a proponent of today. But what asset classes or sectors or strategies are you personally bullish on?
So energy meaning, call it fossil fuels or hydrocarbons, whatever you want. Full disclosure, I drive a Tesla.
Because it's cool.
What's that?
Because it's cool.
It's cool.
By the way, Rob, even though you charge the car, it's made of plastic, which has hydrocarbons in it.
It's not only that, but it's charged. It's plugged in. And if you take the plug to the car and go all the way back to the source, it's going back to hydrocarbons. Hydrocarbons are necessary. There's been lots of studies on the impact of all of the green initiatives. And I think it's possible for the US to be completely green, whatever that means.
Like the year 2500, maybe?
It's impossible for the world. So the world population is growing. There's huge, and by the way, there are economies that are maturing. There's Africa, India, Asia, they're just growing up. This has all been happening over the last few decades. Africa is projected to be the fastest growing economy for the next 30 years. Now, they're starting from a small base, but there's a lot of investment that's going to be made in Africa. There's a need for energy. Energy improves lives. I spend a lot of time with guys in Texas, and they'll tell you that the reason the world is in such great shape today, and it is historically from a wealth perspective, it's the wealthiest humans have ever been in history, is because of energy. But if you look at all of the green initiatives that are envisioned, the solar, the wind, the waves, whatever it is that people are trying to do, one, they're not so green because, to your point, Ross, it takes something to create all that, and almost everything's made out of plastic, which is a derivative of hydrocarbons. But if you look at if they did every initiative and had the solar, they had everything, unless we went 100% nuclear, which is very green, but not going to happen. There's just too many people that hate it. It's impossible to get away from hydrocarbons. And I saw one particular McKinsey study that said if they did everything they proposed on the green side, it would barely absorb all the new demand for energy that's expected over the next 30 years. So this green initiative is just helping us absorb new demand. But what we have today, we have. And I think there's potential for more efficient access to hydrocarbons, more efficient burning of those hydrocarbons to make them greener. There's a lot of things that can happen, but energy is important, because if you start taking energy away from people, the quality of life across the globe will decline. So I'm very bullish for that reason. At just high level, I'm very bullish on the economics of it, because there are a number of different economies, notably the Saudis, that control pricing. And the Saudis absolutely have control over pricing. And their minimum price to fund their economy, everybody lives off of oil there, everybody gets a check. They're investing in their future. They're investing to diversify from energy. They're never going to be diversified. They prop up a price that's around $80 for a barrel of oil. At $80, every energy business makes a lot of money. Every oil business, whether you're drilling meaning you're going in, putting a fresh well in the ground, oftentimes you're fracking, whether you're drilling or you're buying into existing wells, $80 is a lot of profitability. So I'm very bullish on the cash flows of energy, specifically oil. Obviously, natural gas and others are good too, but I'm big on oil for that reason. On the real estate side, There's a lot of activities that involve real estate, right? We're shopping, we're working, we're shipping things. But the one thing that is immutable, no matter how our lifestyles change, no matter how less we're going into the office, no matter how much more we're shopping online, the one thing that doesn't change is we need a place to sleep. And on top of that, we want to sleep in the South. There's a big bleeding sound coming down, a big sucking sound coming down to the South as people move from the North or the Northwest or Northeast, the Midwest, move to the South. So there's a need for housing, again, broadly. There's specific markets which are better than others. There's certain types of assets which should perform better than others, but just broadly, very bullish there. There's other things that happen in real estate that I'm bullish on. So people are moving a lot. People are getting older too. You got to look at demographics and looking at trends. People are moving a lot. They need a place to put stuff. They're downsizing. They're moving to other markets. Storage is an incredible story. It's one of the highest performing asset classes over the past 30 years. Not a lot of cash flow up front necessarily, but very bullish on the outlook for storage. When I look at office, there are office buildings doing really well that are really full. That's not most office buildings. That's not the traditional office building in most major cities, because I know for myself, I'm a big believer in the office. I have an office. I go to the office, but I'm only there 3 days a week. So utilization of office has decreased. Now I'm still paying the same rents that I would have if I used it 5 days or 7 days a week. But I think office is going to be challenged for a while. Retail, some retail is challenged. Obviously, we've seen what's happened to malls. We still have to go to the grocery store. I don't think that Amazon can completely replace that, but incrementally, there's lots of things that are being done online that are not done in retail. So not as bullish there. And the other asset class I actually love is industrial, because everything is online now and shipping, and industrial is warehouses and whatnot. But that everybody sees that. Everybody's jumping into that, and it's driven yields down significantly. So it's really hard to make good money. It's great. It's safe. It's as safe as you can get. It's predictable cash flows, but that's why all the institutions have jumped in, driven prices down. So hard to get yields on there. So there's other asset classes within housing that I like manufactured housing. If storage is number one, manufactured housing is number two. That is, if you think about the aging population, people downsizing, people moving to southern states, from Tennessee down to Florida, a lot of them are buying manufactured homes, smaller homes. They're not mobile homes like they used to be. They're nice homes that were built in a factory, but are 2-bedroom, 3-bedroom, really nice product. That business has really done well too. Lots of things we look at. We start with kind of a macro view of things, and then we drill down. And then within a particular strategy, we look for the best operator, the people we want to work with, that we feel have the investor's interest in mind all the time, and that we think can execute on their investment thesis.
Makes sense. We talked about before about having a good hotel sponsor that through COVID, something we couldn't have seen worked out the distress in it. We brought up office a couple of times, and it's funny. Everybody I think knows office is under a lot of stress right now, but there are people out there with real estate strategies in the office space that are finding ways to make a lot of money, right? Building a new office building right now, maybe not the best way to make money in office, but I think I saw BREIT sold an office building for a $500 million loss or something like that in the past couple of weeks. But talk about why a REIT structure. So this is a combination of asset, distress, and structure. Talk about why somebody like that would sell that asset out of their portfolio at such a loss and not find a way to work it out and try to reposition it. And then who does that create the opportunity for somebody to buy that asset to now turn it back into more money? Because if Blackstone doesn't like it or BlackRock doesn't like it for $500 million, why would anybody like it? Aren't they the smartest people on the planet? Like, they have to know how to do this kind of stuff, right?
There's a price for everything, right? And sometimes if you look at, if something's so distressed, it's not worth even the land it sits on, right? Because you can have situations where the real estate is so distressed, it's a box that can't be used, and maybe not a downtown office building, but it may be some old dilapidated building that in order for you to make use of that land, you would have to not just buy the building, but you'd have to tear it down, build something up. And if you did the math on what the end product is, it's worth negative. So they should pay you to take it. Now, in the case of Blackstone, I don't know the particulars about that deal, but I've seen it with a bunch of different Brookfield did this in LA. They put a portfolio. I think they lost $300 or $400 million. They gave it back to the bank. And what I'm, again, not knowing the particulars, Blackstone, they are smart. They think they're smart if they're not. My gut tells me that one, $400 million is a rounding error to them because they're so big. And two, that they had to put more capital in it than they could foresee getting out of it in the near term or over a period of time. They likely had debt on it. If you've got a building that is half empty or a quarter full, you probably don't have enough cash flow to cover your debt. So at that point, you need to start thinking, do I even want to have this? Do I have some prospects to lease it up? If the building is in downtown San Francisco, odds are pretty good it's going to be a while before it comes back. Doesn't mean somebody can't own it, right? If I have to be 75% leased at a $500 million valuation, maybe I can't get there for a while. But at a $100 million valuation, I only need to be 15% leased or 20% leased so I can get there. So there's a reset there. And it's a firm like that saying, look, we're in this. Blackstone's business model is to invest in real estate that is predictable. Their investors, they have a lot of retail investors, but the core of their business is serving pension funds, sovereign wealth funds, endowments. I started this conversation talking about actuarial investments. This is where a lot of money is concentrated. That money has future obligations that they're trying to solve for. In the case of a pension fund, there are people that are going to retire and live 17.3 years or whatever the actuaries have come up with. And they need to know they have a certain amount of cash flow in that period of time. So the reason they like office historically is because office, the shortest lease you're going to get in an office building is 5 years. Your anchor leases are going to be 20 years. So you have longer leases, predictable cash flows in a normalized environment, predictable expenses. And so these institutions like to invest in that type of asset. If all of a sudden it becomes distressed, those benefits go away. So what do I do if I'm Blackstone? So I'm trying to serve this type of investor. And by the way, the retail investors that invest with them, if you're making the decision to invest in Blackstone, that's all you want. You just want to check every month or every quarter whenever they're sending it out. You're not looking for a lot more than that. So if that asset can't deliver that, it doesn't belong in the portfolio anymore. And you've got to start thinking, how can I extricate myself? My gut tells me that they lost money on it, but they didn't go to zero and it didn't go negative. That's what makes them smarter than other guys like Brookfield. They did a similar thing and they gave the keys back and had to pay the lender some money. Sometimes it's a relative thing, but in this case, they're extricating because it doesn't suit their investment objectives.
Hey, I just wanted to interrupt the show real quick and tell you about an exclusive member discount for Legacy Point Group members. The company is called Gelt, and they're both tax planning and tax preparation. We connected because their CEO actually comes from a family of physicians, and he understands the financial complexities that healthcare professionals face these days. Legacy Point is honored to partner with Gelt because it's our shared mission to empower successful professionals with optimal tax and financial outcomes. For your 20% discount off financial planning and tax preparation and priority access with their onboarding, become a member over at legacypointgroup.com.
You made a great point, and it comes full circle. We talked before about a value add multifamily person that there was really no value left to add, or they paid for all of it when they bought it, and then there's no room to make any money. In this scenario, if the person that bought that building from Blackstone for 20 cents on the dollar says, okay, we have a strategy. We are going to fix this thing up. Our cost basis is 20 cents on the dollar. We're going to call tenants that are in other buildings, and we're going to say, look, if you want to move over from your building to our building, we'll buy you out of your lease or whatever it takes. We'll put the CapEx into the unit that you want, right? So that you have and do you want just as much space at half the price, or do you want, double the space, or what do you need? And then so they've got a lease up strategy for that building to bring people in at a much, because if you can move right across the street and you're paying just $40 a foot over there, and you can come over here and pay $15 a foot, right? There's a point where that starts to make sense. So we've seen office people in our space buy buildings for 25 cents on the dollar because other people had to sell them because it didn't fit their strategy. And when they threw it off because of their strategy didn't work anymore. There was somebody else that was able to buy it at 25 cents on the dollar and value add it and make it worth more money. Whereas in that scenario, value add works. But in the other scenario where you bought something at the top of the market and swore to God that you could value add it and there was no meat left on the bone. So that doesn't mean throw the baby out with the bathwater, and that value add as a strategy doesn't work because you lost money in a value add deal. It had a lot more to do with, you had to dig into the nuance to really understand that. And I think sometimes investors are like, I'll never invest in multifamily again, or I'll never invest in value add again because they maybe had a bad experience. Or the converse can also be true in the inverse. Oh, I only love value add because I found this one great deal. And then they stumble across this thing where there was no value to add and they get murdered in that deal. And then it gives them a bad experience. So it's knowing a lot more about the deal than just asset class or value add per se.
I've talked to investors who had some value add deals in recent years go sideways, which we could talk about that for hours. But because of that, they didn't understand the difference between value add and ground up development in multifamily and how they truly are apples and oranges. But because of their bad experience with value add, they were very turned off by ground up development multifamily in the Sun Belt. And so it's really interesting because some investors are really smart people in their one little lane, but they're just not very smart when it comes to this type of stuff. And you have to just walk them through it.
Most people, if you got a little bit of coin that you've amassed through something, you're probably pretty smart. I have a doctor friend that is incredibly smart, and he starts talking and my eyes glaze over and he doesn't get it. I start talking, his eyes glaze over. We've all got our expertise. And again, that's where you guys come in and you help your clients and help them find the right deals and help them understand what they're investing in.
Sure. All good.
Yeah.
I think we're getting pretty close to your hard stop on this.
Yes, sir. This has been fun. Appreciate you guys inviting me.
Yeah, appreciate you sharing all your insights and wisdom with us.
All right. Thank you, guys. You all have a good time.
All right.
Bye.
Good stuff. Thanks so much.
Thanks for listening in to Wealth Beyond the White Coat. Your time and attention mean a lot to us. If you found value in today's episode, please consider leaving us a review on your favorite podcast platform and share it with your colleagues and friends. Your feedback helps us grow and reach more professionals like you striving for financial freedom. Until next time, keep pushing the boundaries of your financial health. Thank you for joining us on this journey to wealth beyond the white coat.